How's everybody going? How would you like to learn about this new strategy with stretch that I'm adding? So I'm adding stretch to my ETF mix, and this is how I'm going to do it. This is my thought process behind it. Let me know at the end what you think. So my goals with adding stretch is to provide a rising floor to my income from the ETFs, to reduce investment risk while increasing monthly income over time, and to further diversify my ETF investments. So currently, I have two ETFs that I'm investing in, BTCI and NEHI. BTCI is the Bitcoin High Income ETF from NEOS funds. It pays out around 27-28% dividends yearly, and it pays them monthly, usually around a little bit over 2% a month. It's backed by other Bitcoin ETFs plus US T-bills and uses covered calls to generate income. It follows the volatility of the Bitcoin price most of the time. So if the Bitcoin price goes up, the BTCI price goes up. If the Bitcoin price goes down, the BTCI price will go down as well. NEHI is very similar, except it uses Ethereum, and it has a higher payout. Its payouts usually are around 32-34% a year, and it's backed by one Ethereum ETF. Last time I checked, it only had one in it, plus a bunch of T-bills and covered calls. And it has volatility as well. Currently, my current strategies is I DCA into BTCI with each paycheck, receive monthly dividends, move 33% of those dividends to the checking account, then deposit it into Coinbase from the checking account, and then buy more Bitcoin on Coinbase. Then I reinvest what's left into BTCI and NEHI 50-50. Then on the 15th of each month, I would sell 2.5% of the Bitcoin that I had in Coinbase, deposit that into the checking account, and then invest it into Fidelity, which is what I use for BTCI and NEHI, and invest it into those 50-50. So the pros and cons of my current strategy. Currently, it uses Bitcoin in a Flywheel, which I think is pretty neat, to buy BTCI and NEHI. It buys NEHI using BTCI dividends and a small amount of my Bitcoin. And it takes advantage of NEHI's higher distribution rate. The cons, which is also one of the reasons that I'm changing some things up, is I have to sell some Bitcoin in order to do it. And I really don't like it. I'm kind of trying to accumulate Bitcoin, not sell a whole bunch of it. It buys NEHI using outside funds, which then increases risk. And so if I could get NEHI without using outside funds, that would reduce risk while increasing my income. Plus all that moving around from checking account to Coinbase to Fidelity or to whatever, I have a lot of transaction fees that I have to pay. Plus if I start selling my Bitcoin, it can increase taxes, capital gains taxes and stuff like that. So that's a big con for me. So what is this STR that I'm adding? It's called Stretch. It's from the company Strategy. It's a perpetual preferred stock from Strategy that pays an adjustable annual dividend, and it pays it monthly. Although there's voting going on now that they may start paying it twice a month. Dividend is currently paid monthly, maybe twice a month. Of course, I just said that. It depends on whether their current proposal passes or not. The stock price aims to trade around $100. Sometimes it's a little bit lower, sometimes it's a little bit higher, but they do things to make it go back to $100. The dividend started out at 9% a year in August, but then it's risen to 11.5%. And so it may continue to go up, or it may stay the same, or it may go back down. It's adjustable. But it looks like right now it's gone up. So we'll see what happens when the Bitcoin price continues to go up, whether they raise that dividend or not. Here are the pros and cons of adding Stretch. The price is not very volatile. Of course, Stretch usually trades somewhere around $100. The dividend has risen over time, so there may be some hopes of it staying the same or rising over time even more. And it uses return of capital, just like BTCI and NEHI, so that can help with taxes. The cons, and these are some big cons too, is Strategy is not required to buy back Stretch at $100 per share. The dividends can be suspended if needed. So if the company needs to suspend the dividends for whatever reason, now they can do that. They shouldn't have to do that with the money that they have in reserve. And of course, it's not FDIC insured like a savings account. So how am I going to do this? Well, I first received dividends from BTCI, NEHI, and Stretch as cash. So it'll be the first month it'll be just BTCI and NEHI, and then after the second, starting the second month, it'll be Stretch too. I'm going to take 25% of those dividends and move them to the checking account as income. So it increased my income. And then take the rest of it and divide it into thirds. So 33% goes into, gets reinvested into BTCI, 33% gets into NEHI, and 33% gets into Stretch. And then I'll continue to DCA a portion of my paycheck into BTCI with each paycheck. So BTCI will grow a lot faster than these other two, but these other two will be, the NEHI and the Stretch will be bought with dividends and not outside funding. So the income should go up with the risk remaining the same or possibly going down. So here's the pros and cons. Paycheck DCA takes advantage of the BTCI volatility. So right now BTCI is cheap. It's like $35, $37, something like that. I remember when it was like 60 bucks. So it's on sale, like 50% off. STRC and NEHI are bought using dividends, not outside funding. I was just going over that. Stretch becomes a rising floor of value and income. So Stretch is going to continue to go up because the dividends are going to be reinvested in it. And as it goes up, it's going to increase monthly income. And it'll be consistent. No extra investment is needed while increasing overall value and monthly income. I just kind of went over that. The cons is monthly dividends are still adjustable and can change. With BTCI, NEHI, and Stretch, all of them can change and do change their monthly dividends, sometimes on a monthly basis. And then the BTCI and NEHI ETFs are still very, very volatile. They go up and they go down in price. Stretch will be kind of steady. It'll be like I said in the pros, it'll be a rising floor. Strategy isn't required to buy back my Stretch shares at the normal $100 price tag. So I'm kind of trusting the company, just like I would trust any other type of investment. So when will this strategy start? I plan on starting this new ETF strategy with the next time BTCI and NEHI dividends pays out. They usually pay out on the third Friday of each month. So when that happens, I'll start divvying it up and start buying Stretch. It'll be like getting Stretch for free because the funding will come from the dividends and not from my paycheck. So I like getting free stuff that produces more monthly income. What about you? So what are your thoughts? Are you currently investing in Stretch? Do you think this is a good idea, the way I'm doing it? A good idea to invest in Stretch at all, or a good idea to work it in with my ETFs, this strategy? What are the pros and cons that you see that I may have missed? You know, like I said, we're the learning investor. None of this is financial advice. I'm still learning. I'm experimenting, figuring out what works best for me. And you may have been in it longer than I have, and you know more than I do, and we can help each other out. So, anyways, also, do you like this style? Do you like me doing these PowerPoint presentations? This is something new that I'm doing. So, anyway, thank you again for watching, and let me know in the comments what you think. I'll talk to y'all later.